Hi, Steve Van Metre here, and welcome to your Wednesday night premiere. We take about 15 minutes every Monday and Wednesday night and try to make sense of markets. I don't entirely make sense today, but sort of do. 20% in 20 days. You know, I remember people telling me the market will never go down. The market can't drop that fast. The market is solid. Fundamentals are great. It's bull. Fastest trip to a bear market in the history of the Dow, 20 days. Meaning, over the last 2 years, people that have bought into the market have made nothing. No, actually, they made less than nothing. They've lost money. If you have been buying at any point over the last 2 years, so you put a lump sum in 2 years ago, you're back where you were. If you've been putting money in your 401k, you have lost money. Your financial advisor now has probably made more money than you because they've been billing over the last 2 years at much higher prices. So really, when you factor fees and all that, most people have lost money. The question will be, is when do they sell? Good question. I don't think retail is sold yet at all. But my guess is they're going to get to that point really soon. But of course, what people are now going to look at is, well, bonds have sold off in the last 3 days. Yes, but bonds also went like this, and now they're coming back down to kind of a normal place. You know, it's not entirely unusual to see bonds sell off ahead of the treasury auctions. Most likely what we saw 3 days before is a lot of speculators getting shorted out of their, or I don't know, shorting, squeezed, there's the word, for squeezed out of their short positions. And when you get squeezed, you have to become a buyer. When you're a buyer, prices go like that. The question is, well, shouldn't we have sold? Shouldn't we do this? Look, the story is not over yet. So why are bonds headed down? Probably because the people that got their clock clean shorting bonds thought, well, nobody will buy a 10-year treasury at 0.4%, so I can't lose now. This is God's gift to the short bond market. Okay, go for it. Knock yourself out. Because who is the biggest buyer in bonds, treasury bonds, on the planet? The Federal Reserve. Are they at zero? No, but they probably will be this time next week, if not potentially sooner. And when they buy down to zero, you're talking in a range of 60 to 70 billion of T-bills per quarter percent. So you're talking them buying, I don't know, around 250, $275 billion worth of bonds. Ouch. Not to mention, they're still buying 60 billion a month, which I assume will go up. Of course, when you mop up all the supply, there's not much left for everybody else. So why have we seen the last 3 days? Could it be the treasury auctions? Sure. And who are the buyers at the treasury auctions? You have foreign investors, which is mostly going to be foreign central banks. You have domestic investors who never ever want to buy U.S. government debt until it's absolutely really high and at a level they said they swear they never buy at. So we know they're not showing up. And then we have securities dealers who are owned by the large commercial banks. And we know large commercial banks are buying bonds because by regulation they have to. And of course, large commercial banks also like to sell to the general public, and they will. So sometimes you get this going into these treasury auctions that, hey, this is going to be the first failed treasury auction. Nobody is going to buy a 10-year treasury, at point whatever it auctioned off at 0.8%, 0.75% today or whatever it was. And yet people still did. Now, not quite as many as the all-time record number of bidders, but people still bought. Of course, like I said, speculators hope that there's a day that nobody shows up in the auction. Highly unlikely when you're the world's reserve currency. But in terms of bonds being dead, no, that's not quite the case at all. We know that bond prices do not peak until volatility peaks. And volatility has been sitting like a big giant rocket, just shaking as the engines are fired up, ready to explode higher. I mean, we're going to have one of the biggest, if not the biggest surge in volatility coming very, very soon. Of course, we know the Fed's going to cause that because the Fed causes volatility when they ease into a tightening cycle, which they are. So that's going to be very interesting. So we know that bond prices aren't over yet. We also know the treasury yields don't bottom until stock prices bottom. Well, they haven't bottomed either. And obviously the economy hasn't bottomed. And if you tack on the coronavirus and whatnot, think about this. If parts of the country were starting to go under quarantine where people could not leave to buy homes, buy cars, businesses weren't out refinancing and doing all this stuff, What happens to lending demand? Goes down. What happens to rates? Goes down. Coronavirus is not inflationary. It's highly deflationary. Inflation is when people are out borrowing and spending money. Inflation isn't when I refi my house and take some of my existing debt and squish it into my new mortgage. You say, well, but your cash flow went up. Look, it's not inflationary. I mean, okay, it's inflationary a little bit. But if I don't go out and borrow against that cash flow, so say go buy a new car, say, hey, I saved $300 a month by refinancing my mortgage and bringing all my debt on high interest debt in, now I can go buy that car. Now, when I buy that car and take a loan and say I have $300 a month to make the payments, that's inflationary. That's how money is created. But if I'm just out spending that $300, yeah, sure, it helps, but it's not that inflationary. Because you have to factor money is destroyed as debt is paid off. So if I have an even lower interest rate on my loan, that means I'm starting to pay the debt off faster. Low interest rates are deflationary until there's a surge in lending demand. So as far as the last 3 days in the bond market go, it's not fun, but I'd rather be in bonds than equities over the last 20 days. I can tell you that. Bond prices are up, stock prices are down, stock prices are headed lower, and bond prices do not go down in recessions. They go up because interest rates go down to spur lending demand. I can't help what speculators are doing, but I do know the Fed's going to come in and mop them up, and they're not going to see it coming. So let's take a look at some charts and stuff and see what's going on. If we take a look at the NASI, the NASDAQ McClellan Summation Index, it is signaling that a sell-off is here. Liquidity is gone, and that this should head lower and stock prices should head lower. I think we're on the cusp of a major explosion in volatility, a major collapse in interest rates, and a major collapse in stock prices. This will not be the generational buy, but it's going to look really attractive for anyone that has cash or treasuries in their account. Is look at financial conditions. We went from super loose in a matter of days to the tightest since the great financial crisis. Chart courtesy of Zero Hedge. I appreciate them putting that up on their website. So financial conditions are tight. How could that be? I thought low interest rates were easy. Made easy financial conditions. Nope. Low interest rates cause tight financial conditions until they ease, and they're not easing. Just because people are out refinancing their house doesn't mean anything if they're not spending money. Let's take a look at some charts. Picture is not pretty. Let's start with TLT. And I know people are interested in the bond market. First of all, it gave back this monster move here. So here we can probably assume speculators were squeezed out, and then they decided that they wanted to come back and short. What we're seeing is a bullish flag. What is a bullish flag? Well, it looks like this. So when you have a quick rise in stock prices, and if you've been watching these videos for any length of time, we've gone through this part as investors. But this is a bullish flag where you have sellers, but buyers keep coming in and pushing price. Sellers come in, buyers push in, sellers come in, buyers push in. And at some point, either the sellers win or the buyers win. And the great thing is, again, remind yourself, if you're worried about bonds, it's simple. Who is the biggest buyer in the market? The Fed. Are they done buying? No. Are financial conditions loose where people are out spending money? No. So, okay, this is temporary. And I'm going to show you why this is going to get unwound. So the Fed's buying into here. Commercial banks are buying into here. And the way these speculators get squeezed out is as bond prices rise, all these people who are short get squeezed out of their positions and either cancel out their shorts or turn into buyers. And all of a sudden you get boom, 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 boom until they puke. And the sellers have had the maximum amount of pain. But keep in mind how this pattern works. It's a flag. So if we zoom out even on a bigger scale, you can see it looks like, a pennant, or like you would hang. Remember those? Now, some of you may be too young to remember when people hung the pennants from different colleges on the wall. I had some from relatives. And so you have the flagpole and kind of the flag draping down, like there's not a whole lot of wind. So now let's zoom in to the last 10 days of TLT. And what do we see? Overnight, prices are going up. Sellers come in during the day for the most part. Sellers. Overnight, prices go up. So there's obviously buying in the overnight. And then we have selling in the overnight, buying in the overnight, selling during the day. Selling during the day tells me a lot of who's selling. Is somebody trading U.S. exchanges? You can almost see here where the European markets closed and then selling came in. Overnight we had buyers. Sellers come in again. And now we have some buyers showing up, at least as far as we know at the moment. Do you see how here we have the flagpole and the flag? So should the bulls come out winning on this deal, which again I believe they will because the Fed is buying and interest rates don't bottom until the economy is complete in the toilet, and it's currently not there yet by any stretch of the imagination. So as the bulls eventually reclaim this and push this up, what happens to the people that are short here? They get squeezed out and turn into buyers. And then they squeeze these people out, turn into buyers. And they squeeze these people, turn into buyers. And next thing you know, you're back at new all-time highs. Treasury yields are at zero and big profits for those who held bonds. Sell those and buy stocks. We can also overlay volatility, symbol VIX, and volatility is still rising. So we're not seeing any indication that volatility has peaked here at all. In fact, we're seeing quite the opposite. What's very unusual with volatility is normally, if we go look at the VIX, it should have peaked by now and been coming back down. The market should have bottomed. But because the Fed is easing into a tightening cycle, they're persistently pushing volatility up and they don't know it. So the next time they do a rate cut, if not sooner, volatility is going to get out of the bag here and take off and cause a major unwind in stocks. And then the Fed will cut some more and they'll blow this thing up. And as I've shown you here, look, we're at an extremely high point now. At these points in the past, the VIX has rapidly reversed. Volatility has absolutely crashed. It's not. Means this thing is going to blast through probably the highs of the great financial crisis. If you think the selling the market is bad now, you've seen nothing yet. Take a look at the Dow. Let's go and zoom in on it. It has erased all the gains. Anybody who was buying late 2017 and roughly thereafter is losing money. The only people that made money is anybody who bought in December of 2018. So in 20 days, all these returns wiped out. And this is kind of the last point of technical support. You break through here, and this thing's going to continue to sell down. Probably the next destination is going to be somewhere between 17 and 18,000. How about the S&P? Almost the same story. It's wiped out gains going back into 2019. And anyone that bought after above this dotted line here, it's going to break down some more. Small caps already are broken. They're down. Look at small caps. They're back where they were in 2015. Since small caps lead large caps, what does it tell you where the S&P is headed? If the S&P was back to its 2015 levels, you're talking 2,100. You want to see how much selling is going to occur there? How much volatility is going to happen? It's going to go through the roof. If we look at VXX, the volatility ETF, you'll never trade. It breaks over 41. The cat's out of the bag. You can see that. This last kind of point of heavy shorting was kind of right in here. These people lose control. The Fed's injecting a massive amount of liquidity and can't control it. But how about emerging markets? They tell us a lot about what's going on. Emerging markets, let me zoom out and then we'll zoom back in. See this white or gray shaded bar? This is the bar of doom. Volatility gets crazy in here. If it breaks through, it gets through the roof. Volatility is going to spike. Boom. Great financial crisis levels based on where we're at now, if not more. And look at where I said the other day, we're 24 to 72 hours and knowing where this market is going. And it hit that boom on Monday. Tuesday, it came flying out of there. And look at today. It closed right in there. If the market doesn't turn, this thing is game over. It's game over. So the Fed's going to cut a week from now. The only question is, will they go to zero or will they do more? I don't know. I don't mean more by negative. I mean kicking up their $60 billion per month of bond purchases. And as I mentioned the last 3 days, part of the reason you're probably seeing this sell-off in bond market is On Friday, the Fed bought $400 million of floating rate notes, which is a pittance compared to what they normally do. They spent all their money in the first week of a lot of their money the first week of the month. They bought nothing yesterday, or maybe they didn't buy anything on Friday, but they bought maybe it was $400 million on Monday. They bought nothing yesterday, nothing today. So the biggest buyer is kind of just out of the picture of the moment. Now, that doesn't mean tomorrow they're not back buying $7.5 billion of T-bills or something else. I mean, they still have to meet their $60 billion per month quota. They just kind of overdid it last week and helped drive bond prices up to squeeze out the sellers. Well, guess what? The sellers are creating a new supply for the Fed. You say, what do you mean? Because when you short a bond, you borrow the bond from the dealer, right? So I'm going to borrow the bond from the dealer. The dealer still owns the bond. I'm borrowing a copy of it, and I sell that copy on the open market. That one bond now becomes two. That's why you see these moves in the treasury market that can be very quickly to the upside and quickly to the downside, because essentially when sellers come in, they're just creating a whole lot more supply. Well, guess what the Fed needs? Yeah, they need a lot of supply. I'm Steve Van Metre. Thanks for watching. We'll see you Friday. The content of this video is provided as educational information, is not intended to provide investment or other advice. This show is not to be construed as a recommendation or solicitation by selling security, financial instrument, or participate in any particular trading strategy. This video was prepared by Steven Van Metre, own personal capacity. Opinions expressed in this video that I'm going to do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial.